Hello and what is going on, lovely people of the internet? It is Who Money here with another video for you guys today. Today we're going to be doing an analysis on energy transfer stock. Now I really like this. This is a good value slash reopening play. So before we get into it, I'm going to kindly ask you guys to subscribe to the channel and turn on post notifications if you haven't already. And the number one thing you can do for me as a viewer is to like the video. By liking this video, it helps show my content to other people on YouTube. So I would really appreciate if you guys did that. And we're going to get right into this video in just 1 second. But if you guys have not yet invested in the stock market, you guys can sign up with the link below using WeBull. And you can get 2 free stocks valued up to $100 a stock. So I'm really excited to make this video. I did a lot of research in preparing for this, and let's get right into the video. So here we are back on finviz.com. As always, I'm not affiliated with Finviz. I just really like this website. So as you can see, Energy Transfer has been trading in this channel and it's right around resistance right now. So you may be able to get a better price on this stock in the short term. However, I still think it is a good long-term play, but we'll do a little long-term technical analysis, which I don't take too much meaning to because it is technical analysis, and I reiterate this in every video that I do not use technical analysis as a trading strategy. But here is the long-term technical analysis, and this is Energy Transfer stock since it opened. Each candlestick is 1 month of time. So as you can see, it is in this clear long-term downtrend right here. And a potential risk is that it's hitting this huge resistance line, which is a long term over the course of about 6 years. So this could be a potential bad thing short term because it could be going down. But then again, it is technical analysis. I do not take too much consideration into it. And if it breaks this trend, it'll definitely seem to trend upwards in the future. We're going to take a look at a few of their statistics. As you can see, they have a 7.54% dividend, and actually as of their previous ex-dividend date in February, they had an 11% dividend. So that's what is attracting people to this stock. People want that high dividend yield, and this is a recovery stock, so people think that it has a very cheap price as well. So when a dividend has a high yield, there's two things: the company could be giving out money to their shareholders that they don't have, which is not a good sign, or the stock is undervalued. So according to these analysts, you can see right here, all 3 of the previous analyst predictions have been upgrades. So that is very good for this stock, and I think it's undervalued as well, and we're going to get into those reasons why in this video. So due to the pandemic, they were not profitable, so they do not have a price to earnings ratio as of this year, but their forward PE is 6.38, which is also pretty good and signals that they are undervalued. Then their price to sales ratio is 0.55, which is really good, especially for this industry. We're going to get into that more later, but I really like that as well. Then another interesting statistic is that their beta is 2.45, which shows that this stock is pretty volatile. So I think you can actually, because of this beta, I think you actually could get a better price for this stock. I think you can probably get it at around $7 a share if you are patient. However, when investing in the long term, that does not matter as much. So as you can see, it is up 37% over the past year. Around this point is basically the peak of where they fell after the coronavirus market crash, and it has recovered ever since. It is not quite at their June 2020 levels yet. Alright, now we're going to get into my analysis of this company. So a quick overview of this stock is that Energy Transfer provides energy related services. This company owns and operates approximately 9,400 miles of natural gas transportation pipelines and 3 natural gas storage facilities in Texas. It also sells natural gas to electric utilities, independent power plants, local distribution companies, industrial end users, and other marketing companies. Energy Transfer owns the largest pipeline network in North America at around 90,000 miles of pipes. They make money by transporting and storing energy products, which does not result in a large dependence on a high oil price. This company does do some business with oil, but it is mostly a natural gas company. So, potential catalysts for this stock. Their share price is down massively over the past year due to the COVID-19 pandemic. So this stock has actually recovered a bit, but as you can see, it was trading at around $10.67 a share before the coronavirus market crash. It's still on its way to reaching that recovery. Due to the low share price, it's looking like a buy the dip situation with this 8% dividend yield. This is one thing in particular that has made me extremely bullish on this stock. So over the last year, insiders bought 13 million shares, while insider sales over the same time frame totaled just 450,000 shares. So this means for every insider share sold, they bought around 30. So if the management team is buying up their stock, that means they know something. They know this stock is due for a large upward spiral. With the pandemic ending and people leaving their homes, there will be a much larger consumption of energy, which makes this a good recovery play. Energy Transfer mostly deals with natural gas, which is a much cleaner fossil fuel than oil. So I like that personally because there's a lot of demand in the clean energy market. And although this is still a fossil fuel company, natural gas is much cleaner than its oil competitors. So management has actually stated that they are looking to reduce their capital expenditure, and they're going to use this extra capital to pay off some of their debt. So we're going to get into their debt later, but that is one of their risk factors. And with a price to sales ratio of 0.55, which is lower than the industry average of 1.35, this stock can see a massive upside. Another catalyst is that they recently acquired Enable Midstream at a very cheap price during the pandemic, and this will enhance their credit profile and asset footprint while also generating at least $100 million in annual cost savings. Their free cash flow should be going up because of their lower spending and their upcoming merger with Enable Midstream. This will allow them to buy back equity and increase the dividend. So on this chart right here, we are going to be taking a look at their quarterly dividend. So before the pandemic, they were giving out 31 cents a share on average, and they slashed that in half to 15 cents per share once the pandemic hit. So it is not a good sign for a company to slash their dividend. We always want to see dividend companies that are increasing. However, since this got hit really hard by the pandemic, we're going to let this slide right now. And there's hopes that this dividend will be increasing in the future with the raised free cash flow. Now we are going to take a look at the potential risk with buying this stock. So the big risk that everyone is looking at is their $51 billion in long-term debt. However, none of these obligations are due within the next year, and they actually have their short obligations already covered with a current ratio of 1.07. So if you have a current ratio of above 1, that means your current assets are greater than your current liabilities, and you will be able to cover any liabilities you have that are due within the coming year. So with their large amount of debts and increase of interest rates, which has been a growing concern in the economy, this could negatively affect them as they are a highly levered company. Now another risk is that their revenue has decreased in 2020, and this is largely due to the pandemic, but analysts believe that recovery is imminent. However, the cost of revenue has also gone down, and there's only been a marginal decrease in gross profit. Now these last three risk factors have come from their 10K filing with the SEC. So the first one is fluctuations in the demand for and price of natural gas, NGLs, crude oil, and refined products. As they are an oil and gas industry, if the demand for these products goes down, as we can see, clean energy is becoming a huge thing in this country. So the demand may go down in the future. However, natural gas is actually one of the cleaner burning fossil fuels, so I do not think this is a huge risk. The next risk the company stated in their SEC filing is failure to successfully combine the business of Energy Transfer and Enable. So if their upcoming merger does not complete, they may see some downside in their share price. And the last risk that I've taken note of from their 10K filing is regulatory concerns with fossil fuels. And I do not think that there will be increased regulation. This industry is so dominant. It is a backbone to the infrastructure of America, and they have immense lobbying power. Now, Biden has recently revoked the permit to continue building the Keystone XL pipeline. Now, I do not think that this will carry over to natural gas pipelines because, as I have said before, natural gas is a much cleaner burning fossil fuel than crude oil. Now, here is the long-term debt chart of Energy Transfer. So as you can see, back in 2006 when this company originated, they were at $1.89 billion in long-term debt. Now we're at a whopping $51.4 billion. So this is actually a concern of mine because it has seemed to taper out over the past 2 years. However, this could be continuing to grow, and with their business being hit by the pandemic, it is hard to imagine that they will be paying off, even though they have said they are going to be increasing their free cash flow and paying off some of this debt. And as you can see here on their balance sheet, their long-term debt obligations are substantially high. And then their long-term assets are substantially lower. Most of their assets are in property, plant, and equipment. So they do not have liquid assets to cover these long-term debt obligations. So going forward, that is a huge risk factor to be looking out for if you're investing in this company. You want to see this company eventually pay down their debt so they can become a less levered company and deliver more of that value to the shareholders. All in all, I think Energy Transfer is actually a pretty good value play considering how much it has been suppressed and its very high dividend it pays out. I think this company has a promising future as long as it does in fact pay off some of that long-term debt, because that is a huge liability hanging over their head, and the amount of leverage they're using to run this company is pretty substantial. That's gonna be it for now. If you guys are still around, I really appreciate your time spent watching this video. If you enjoyed this content and you'd like to see more, remember to subscribe to the channel and turn on post notifications. But the number one thing you can do to support me and my research and due diligence is to just give this video a thumbs up. I appreciate that the most. And yeah, and if you guys have not yet invested in the stock market, remember to use the link below to sign up for WeBull, where you can deposit $100, get 2 free stocks. When I did this, I actually got $60 worth of stocks, so that was a 60% return. It took about 2 weeks to get the stocks, so 60% return over 2 weeks, that is a pretty good return. That's gonna be it for now. Thank you guys for watching, and peace.